Okay, what is up, traders? What's up, tycoons? Today's video, we're going to talk about oil's plunge, likely setting crude up for a significant rebound. We're going to dive into that a little bit. We're also going to go into some charts. Okay, we're going to take a look at XLE. We have the weekly chart here. We'll break down this as well as the daily chart on XLE. Also, we're going to take a look at USO. We have the weekly chart here. I'll break this down for you guys as well as the daily chart on USO. Okay, now we're also going to dive into a little bit of the fundamentals on XLE. I'm possibly debating adding some XLE into the 50K portfolio challenge that I have on YouTube. We'll go over those using today's sponsor, which is Simply Wall Street. It's a really great platform. You can use the link in the description to get a 14-day free trial. But before we move any further, okay, the content provided in this YouTube channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. Myself and any individuals that appear on this YouTube channel are not registered financial advisors. Trading in stocks, bonds, commodities, and crypto involve a significant risk of loss and is not suitable for all investors. Be sure to read through the full disclaimer before moving forward. And right here, we can see all right, oil prices have taken a beating in recent days with crude prices falling over 14% so far this year. This has been caused by concerns surrounding the global economy, but action is likely overplayed at this point. The dollar may be having a role to play here, and that, combined with fears about the economy, could continue to push crude down near term. But fundamentals are current on the bull side at this time, and prices should recover. The past couple of days have been very difficult for investors in the energy sector. With the exception of Friday, we saw a nice bounce. Crude prices have fallen significantly as investors fear continued rising interest rates and economic uncertainty. In the near term, investors should not be surprised if downside continues, but in the grand scheme of things, this pain will likely be short-lived. For those who still insist on investing in the oil and gas sector, allocating capital towards safer companies like pipelines might be the best way to go. But as prices drop, it would be a wise idea for market participants to bargain buy the companies that are most exposed to energy price fluctuations. Perhaps the most significant players would be those in the exploration and production space. Now, 2023 is proving to be a rather difficult year for investors in the energy sector. From the middle of last year through the end of last year, natural gas prices plunged by more than half. I made tons of natural gas videos, and now oil is experiencing downside too. After peaking, WTI crude prices plunged 44.5%. Year to date, WTI crude prices are down 14.4%. A good portion of this decline has taken place over the past few days. Since the end of April, crude prices are down 10.7%. Much of this drop seems to be attributable to growing concerns over the state of the economy. The banking sector continues to rumble with the collapse of First Republic and concerns that Pac West might very well be next. In addition to this, the Federal Reserve decided to raise interest rates in another 0.25%. In recent comments, Chairman Jerome Powell seemed dismissive regarding the collapse of Silicon Valley Bank that started this mess, and he indicated that a higher for longer interest rate environment is probable. Given these developments, investors would be right to wonder what the future holds for crude. In the event that the economy suffers, we would likely see a downward revision in crude consumption. Even a small move in consumption can prove rather painful. Consider that WTI crude prices averaged 105.79 per barrel in June of 2014. By February of 2016, prices were down to $30.32 per barrel. This was caused by production outpacing consumption by only 1.8% in 2015, with forecasts of continued but smaller outpacing in 2016. Prices remained low for multiple years after that as well. Part of the problem is that the price elasticity of demand for crude is quite low, and the significant lead times and investments required to produce it makes cutting output a long and painful process. To those who follow the oil data that's out there rather closely, this recent pricing action may seem peculiar. In March of this year, Russia announced that it was cutting its daily production by 500,000 barrels. This was followed up in early April with the news that OPEC Plus, excluding Russia, was cutting its daily production by another 1.16 million barrels. Around that time, the EIA data indicated that we were moving in the direction of a surplus of crude. On the other hand, the OPEC data indicated the exact opposite. Given this OPEC cut, it seems clear to me that the group of countries is of the opinion that perhaps the picture was not as rosy as they previously thought. All right, and we can take a look at crude right here on this chart. That's essentially what we're looking at right here. We have the OPEC implied oil shortage. All right, Q2 of 2023, it's at 0.5. Q3, it's at 2. 0.06, and then Q4 2.64. The EIA implied oil shortage is at 0.35, with Q3 at 1.02 and Q4 at 1.05. So you can see a difference in OPEC and the EIA. Now, running the data, however, I started to wonder whether there's any reason to be concerned. In researching for this, I looked at both the OPEC data and the data provided by the EIA. If we assume that all of their forecasts and their estimates are correct, and that both Russia and OPEC cut production in the amounts that they claimed they would, then the second quarter of the year, according to OPEC, should see oil demand exceed supply by 0.5 million barrels per day. For the third quarter, this should grow to 2.06 million barrels per day, while for the final quarter of the year, it should be 2.64. Even if we assume that the EIA data is accurate, we should go from having excess demand of 0.35 million barrels per day in the second quarter to 1.05 million barrels per day by the end of the year. This implies rather significant inventory declines if we don't see a corresponding drop in demand. And this chart that we have here, we have global production here in blue and then global consumption here in green. All right, and we can see that the consumption sharply dropped below, and we're basically hitting those levels right now, kind of trying to reach an equilibrium, but it doesn't really stay there for long, right? It typically goes above or below the global production level. All right. Now, this is not to say that we can experience or won't experience a drop in oil prices. Quite the contrary. If we ignore what happened during the COVID-19 pandemic, because that was a self-imposed shutdown of the global economy that resulted in a plunge of oil consumption, prior to that, the last big economic crisis that we experienced involved the 2008 and 2009 financial collapse. But the data for that time period actually looks interesting as well. For instance, WTI continued to rise until about the middle of 2008. Prices then plunged as the global economy started to suffer. Despite this, the amount of oil production could not keep up with demand, with the shortage of oil as measured by barrels per day actually climbing until late that year. But we really didn't see a start to the decline in the daily shortage until 2009, right? And so we can see here that we have the shortage, all right, in this blue line here, and then we have the WTI crude price. All right, and over here we have the shortage, million barrels per day. Same thing on the blue line. We have the dollar index here in gray, and we have the WTI crude price here in green. All right, and this is kind of just visualizing, giving you guys some visuals about what we were just talking about here. Okay, now this is the dollar. So there are other aspects to the oil markets. While the balance between supply and demand is ultimately the most important factor, another one is the strength of the dollar. As you can see in the chart above, you see how this looks next to the prior chart. As the dollar showed weakness in the early days of the financial collapse of 2008 and 2009, crude prices increased in the chart below. You can see that the dollar has been strong as of late. High interest rates and the relative health of the U.S. economy are responsible for this. But what it does suggest is that in the short run, weakness in pricing could be driven by that. And so we have the US dollar index here, and we can see the decline. We really peaked in about October of last year of 2022, October, November area. And, we did get a slight little bounce to start off the year, but really ultimately the US dollar index has really just been dropping pretty significantly. So ultimately, as a takeaway, it's clear that the bears are having their day. And in truth, we could see that trend continue for the near term. Absent a significant weakening of the global economy, it's difficult to imagine oil prices needing to decline. In fact, it's likely that we're going to be dealing with a more severe shortage of crude over the next few months that could set us up for even more bullish conditions moving forward. The strengthening dollar, combined with an overreaction by market participants in the face of economic circumstances, will likely offset this in the near term. But absent a significant deterioration in demand, I do believe that the outlook from here is largely bullish. And, I did add one energy stock to the 50K portfolio here recently. You can watch that video, guys. I grabbed 100 shares of PBR, which is a Brazilian energy company. All right. Now, if we dive into XLE real quick, okay, and take a look at some of their fundamentals. Again, this is using the Simply Wall Street platform. It's a really great platform and really helps you guys understand fundamentals in a really simple, easy to understand way with some great graphs. And they present everything in a very concise manner. We can look at the valuation here, okay, and they got a 3 out of 6 on the valuation score. So, there's a couple things, below fair value, significantly below fair value. If we take a look here at the share price versus fair value, Simply Wall Street has this thing at 64% undervalued right now, with the fair value up here in the 200s. And that's based on looking at its future cash flows, right? So for that estimate, they use a discounted cash flow model. All right. The return on equity also scores really well on XLE. It's at 33.8%. That's considered high. Right. Now the dividend, all right, the dividend gets 3 out of 6. It does have a notable dividend. It is a growing dividend and with earnings coverage. But it's not necessarily the most stable dividend. If we take a look here at their financial position analysis, all right, their short-term assets exceed the short-term liabilities, and their short-term assets exceed their long-term liabilities. So it does get a check mark there. It looks pretty good. The financial health is a 4 out of 6. All right. So, that's some good information right there. If you look here, it has a 0.1% debt to equity ratio. Right. And then we've got a 3.8% dividend yield. That's pretty nice too, as well. That's why I'm looking at potentially adding some XLE into the dividend portfolio. I mentioned PBR. PBR has an insane dividend, over 50% on that one. So that's one of the main reasons that I added that into there. Okay, also Brazil is part of the BRICS, right? Brazil, Russia, India, China, etc. So that's kind of why I hopped in that one. Again, what I want you guys to do, okay, is use the Simply Wall Street platform and look up some energy stocks, right? Some actual individual stocks in the sector, and go ahead and plug them into Simply Wall Street. It's going to give you guys some really great breakdowns, help you understand things on the fundamental side a little bit more. I do a lot of technical analysis on this channel, but that's not always for everybody, right? And just technical analysis alone isn't why you should be trying to invest in something. So if you use that link in the description or in the pinned comment below, you guys will get a 14-day free trial, as well as the first 100 people get up to a 40% discount on their purchase. It's really not even expensive anyways. I've been using Simply Wall Street for a while, and I'm glad to have them as a sponsor. Now, here we're going to take a look at the weekly chart. Now, the main thing that I really want to highlight, okay, starting off here, is implied volatility compared to historic volatility. Okay, that's what we have that we're looking at right here. If you guys take a look, we have the historical volatility in purple, implied volatility here in this brightish blue color. And those are very, very low, right? I mean, if we take a look, it hasn't been this low since December really of 2021. So, with that being said, I'm pretty interested in this right now. Now, implied volatility being low and historic volatility being low does not mean that the stock has to go up or that it has to go down, right? It doesn't give you the sense of the direction. What this tells you is that a big move is coming, right? If we take a look here, we can see that we actually had a very big move to the upside afterwards, right? XLE was over here in the 50s, in the very low 50s, and then it ran all the way up to the 90s here, almost hitting $95. So that was a really, really big and rapid move. And we're back here at those really, really low volatility levels, right? And so if you're an options trader, right, when volatility is low, I just dropped a video about this, about credit spreads versus debit spreads. Typically, you want to be an option buyer when volatility is really low, because as implied volatility increases, that's going to increase the premium on your options. Okay. And then we take a look at the implied volatility. We just did that. If we look here on our weekly chart at the DMI, the way I've got it coordinated is, the red is going to represent sellers and the green is going to represent buyers. And the blue here is the average, right? So, the average is on the bottom, indicating that sellers have, a lot of control right now. Sellers are in full control above the buyers here. So as I mentioned in this article, there is chance for more bearishness near term. Okay, we could see another bounce. I mean, we did see a nice bounce. Remember, when the volatility was really low, we bounced off of this trend line here from these two lows, and we saw a very significant move to the upside. Well, we're actually retesting those lows again, right? This is that same trend line. So we're retesting that trend line along with very low implied volatility. So keep in mind, we're above all of these major levels right here, these support levels, and these are all healthy retracement territory to possibly continue an uptrend, right? 94.71 would be our breakout. We have 103 and also 108 as some bullish price targets to the upside. There's a lot of work to be done, but that's if we break out above our most recent highs here. All right, so that is what I'm looking at. But if we end up breaking this trend line and breaking through $74, there is a good chance we could see a really quick and dramatic drop on XLE, potentially even down to this little range in here, down to like the $65 price range. If we extend this over here to the left a little bit, we can kind of see what I'm talking about here. It's very possible we could drop down into this range, into this next period of consolidation, right? We tested this area over here. All right. And, we consolidated in this area here. All right. We had about 3 or 4 touches, 5 touches right here, within this little zone. So this is an area where, price action is going to be drawn towards if we do end up breaking, through this trend line and ultimately below that 74 2022 level. We could see something known as a look below and fail, right? Where we come down here, we try to find support around the $74 area, and then we push back above this range, this trend line here, and back into the bullish range. That would be significant, right? Because essentially what happens is if we get the look below and then fail, right? And so we actually start to come up here, it's going to be significant because at this point in opportunity, bears are really presented the full chance, right, and the full opportunity on that breakdown to really push things lower and start sending things bearish and try to send it to that $65 to $60 price range. And if they fail to do so, it's going to be indicative that actually bulls are in control. Okay, and that essentially even if bears had the chance, they couldn't take advantage of the opportunity, and bulls have really good control. Now, we did get a bearish rejection over here on the weekly MACD. At this point in time, we're really looking to see if we can, as we see here, we had the clouds turn green here, but we didn't really get any follow through. We didn't retest the previous high, and we did not get a breakout. We actually got a bearish rejection on the MACD, and we've, just continued that downtrend. So ultimately, you're going to want to see a nice MACD crossover to the upside as a potential indicator of some bullishness, right? If we take a look, we got a MACD crossover here and here at these two areas. And that's when we saw some pretty significant rallies in the price, right? We got that strong move up here, and here we got a strong push up to our most recent highs of 94.71. So that's something that I'm looking for when it comes to the MACD on the weekly chart. Again, implied volatility is super low right now. Indicates we are setting up for a very big move sometime soon. If you take a look at the daily chart, we just got something known as a death cross, right? So if you're not too familiar with that, what it is simply the 50-period moving average, right? Crossing below the 200-day moving average. So that's what's known as a death cross, right? So, we did see a significant bounce here off of that trend line. But we formed a doji candlestick, right? And dojis are often reversal candlesticks. We're going to see, if we can continue pushing upwards, we need to be cautious of that 50 SMA now, right? It's going to push down a little bit and be around that $82 price range. If we reject along that 50 SMA, there's a good chance that we could end up, continuing the downtrend, right? As a death cross is seen a little bit as a bearish indicator, right? A bearish trend indicator. We also have, if you look here, this blue gap right here. These gaps, they tend to fill about 90% of the time. So if you take a look, we had a gap in between here, in between these candles, and eventually that gap did fill, right? It took about a month or so. We've got this very large gap down that we haven't filled in a long time on XLE, and it's sitting at that $74 price range that I mentioned earlier. So gaps tend to act as walls of support or resistance, or areas where the stock price is going to be attracted to and essentially act as a magnet, right? So we can see that if we do break below here, it's very possible we come down and fill that gap. Those gaps, they fill about 90% of the time. Again, the big question is when they're going to fill, not so much if they're going to fill. It's really impossible to time the market. So I like to just be aware of these gaps. We did have another gap down slightly above there here recently, and we did come down and fill that gap once we drop down in these price levels over here, right? We were aware of that. We were mentioning it to some of the members in the Discord. All right. So, that's one of the main things that I'm looking at. If we look here as well, the daily RSI was oversold when we were, testing this trend line, and we did see a nice push up, right? So, to me, it seemed like they just had to come down and fill that gap, and price extended a little bit below that gap and reached oversold territory. And we saw buyers quickly step in and push price back up higher. But, that death cross is definitely something to, be cautious of. All right, we want to see if we can get this 50 SMA back up above the purple line here. That's our 200 SMA. Something worth something significant, in my opinion, is we've seen volume spikes on all the sell-offs, guys. That's not necessarily something good you want to see if you're trying to be bullish on this, right? If we take a look, and let's go ahead and put some arrows here, right? We start to see this huge volume increase on the sell-offs right here, right? That indicates, kind of a strong trend. And then as we bounce and we recover, right, and the stock price goes back up, we're seeing this volume decline, right? So we're seeing strong volume on the sell-offs, we're seeing weaker volume, declining volume on the moves up. And then here recently, we had that strong push down, right? So we're seeing volume there, and then we started to rebound a little bit over the past couple of days, and volume is ticking back down again. So that's just something that's a little bit concerning for me, is, that we are seeing volume spikes on all of the sell-offs rather than increasing volume on on the up days. Okay. So, pay attention to that. These are all the key levels, really things that I'm looking at on XLE. If we hop on over to USO and we look at the weekly chart, we clearly have a bearish structure that we're trading in. This is seems a little bit algorithmic to me. Okay. And we're really just creating lower highs, lower lows within this channel, looking for, some type of signal of a breakout, right, either to the upside or a breakdown to the downside. If we take a look at our MACD right here, we are below zero on the weekly chart, and it's very close to getting a crossover to the downside, right? I talked about, when you're bullish, you're going to want to see it cross over to the upside as a potential buy signal. Here, we're seeing it very close to crossing down below. And if we do that, then that's going to be pretty bearish and indicate that we're going to stay within this bearish channel, creating lower lows, or we could even potentially get a breakdown below the channel. So that's something I want to watch out for. We do have a slight bullish divergence here, which if you're not really familiar with that term, just take a look how, we're making these lows here, right? Low here, low here. And what we're doing on the relative strength index is making low, slightly higher low, low. And we're really just trading right along this 38.4 level, maintaining relative strength as the price action is going lower. In this case, this would be a slight bullish divergence, as the relative strength index has essentially remained flat, and we haven't lost relative strength as the price of the stock has actually gone down. We did see a pretty significant bounce as a result from there, but we rejected the top of this channel right here. So we really would have liked to see, a breakout, retest, and push higher here off of that bullish divergence, because we had the top of this channel here. We ended up getting a clean rejection, heading back down lower. Right. So, I'll be paying attention, if we do continue to pull back, can we bounce off of here again and get another chance for a bullish divergence pop? Again, looking at the DMI, right, we can see sellers are in full control, with buyers, losing control on the weekly basis. Sellers definitely, have lots of control in the market right now when it comes to USO. And again, when we're looking at volatility here, the implied volatility specifically is very, very low here on, the weekly chart for USO. So this implies that, volatility is going to increase. We're going to see some type of spike. If we look at the last time volatility, came down to these levels, we saw a sharp decline to the bottom, in a very quick time period, right? We saw a quick move from $69 all the way down to $57. Pretty significant move, guys. I mean, a $12 move there in the price of USO in a matter of 2 weeks. And that's potentially what we're going to be seeing here sometime soon, because volatility is so low. Now it is starting to slowly tick up, but I wouldn't be surprised if we see another $10, $15 move in a short period of time on USO, due to, where the volatility levels are right now. If we go to the daily chart and we take a look, what I've got here is essentially all of our moving averages. Okay, so we have some, simple moving averages. We have some exponential moving averages. This is something that I use to identify trends and look for something in a bearish trend or a bullish trend. And I have a whole scan video actually. You guys can look up exactly trades, how to scan for bearish stocks. Okay, and this will show you, essentially what you're doing is using all of these moving averages, and we can see that they're all it's trading below all of the moving averages. And we most recently, these two right here are the most important ones. All right. They're trading below all of the other moving averages here, right? So we have some different things. We have like the 200, 100, 50 SMA. Then we've got, like a 10 EMA, we've got a 20 EMA, things like that. And those all just crossed over bearish, right? So we can see, we have the crossover uh, at this point here, we have the crossover here at this point. Now they just now crossed over. It's very possible that they could cross over back above. Okay. That's definitely a possibility. But with them being all below the 200 moving average, and all the EMAs below the other simple moving averages as well, we're definitely in a bearish trend right here. So, when it comes to USO, 63.78 is that level we need to get above. If we can break out above there, we need to be very cautious because we're going to have our EMAs here acting as resistance walls as well. And ultimately, we need to see these curl back above. And ultimately, for us to be in a bullish trend, all of these are going to have to be above the 200 SMA. So, for now, all of the moving averages are still below the 200 SMA. Definitely not screaming bullish at the moment. If we take a look here, we have this gap down to fill. Okay, remember what we talked about gaps. This is a small demand zone here from the 1 hour chart. And then we have a larger demand zone here on the 1 hour chart with 5706 as the major support level down below. So, those are some of the key areas that I'm looking at and paying attention to when it comes to USO on the daily time frame. Hopefully you guys enjoyed this video. If you did, smash that like button, subscribe to the channel. Don't forget to check out today's sponsor, Simply Wall Street, using the link in the description or the pinned comment below. It's a really great tool, really great platform for you guys to dive into fundamental analysis a little bit more. And you can get a 14-day free trial using my link below, and you guys will also receive up to 40% discount for the first 100 people to join.